Welcome back. By the way, futures on the US markets are surging now. Dow futures are up well over 800 points, pretty much the highs of the day. S&P 500 futures also pushing higher. European markets are up between 5 and 6%. So we should just keep pulling up some of these indices for context. The world wants to participate, at least for what it's worth for now, in a rebound rally with all the stimulus being thrown at markets and the economy as well. Let's take the discussion forward. Now we have Pramod Gubbi of Marcellus joining us on this leg of the show. Pramod, thanks for joining in. I think people are going to take green with both hands, even if it's a 4-5% move after this 30%, 35% carnage. What is your sense? Do you think this is just a short covering induced bounce, or is this the bottom formation process which has begun?
Well, you've asked $1 million question in our business. Timing the bottom is always, I think, I would go to the extent of saying it's virtually impossible. I don't think any of us can dare to attempt to answer that question. But having said that, I think you can look back at the last 3 weeks and see the sort of destruction in stock prices, which is nowhere close to the sort of destruction in the value of the underlying securities, even if you were to assume a really catastrophic situation. So to the extent that this is likely to carry on for another 3 to 6 months, the impact on businesses will still be significantly smaller, given that value resides in the cash flows to perpetuity. So to that extent, instead of rather timing the bottom of the market, I think investors should look at the fact that stock prices have overreacted compared to the fundamentals of these businesses, particularly the long-term fundamentals of these businesses, and should make use of the opportunity to pick up stocks which they've always thought they would want to buy, but valuations were on the higher side.
Pramod, have end investors panicked in your fund or other funds that you know of in the HNIs? What is the flow activity really? If you can give us a sense, what's been happening?
Sure. Well, I think we've all been sort of pleasantly surprised by the maturity of the investor base, and I just don't talk about my fund. Of course, we've seen significant inflows in the last 2-3 weeks. Existing investors have topped up their funds, and new investors are rushing to open accounts and invest and make use of this opportunity. And I also hear this from other fellow fund managers across other funds as well. So I think the Indian HNI or the retail investor is clearly come of age, demonstrating a lot of maturity in seeing that what's happening is perhaps reflecting the here and now, and not really the long-term fundamentals of the underlying businesses. And we are seeing significant inflows as we speak.
Okay, Pramod, just to talk about the recovery and portfolio construction. Now, let's not talk about timing the market. Let's talk about using this as a time to rejig portfolios or to create an absolutely fresh portfolio. Would you go a little more heavy up on domestic-facing businesses, whether it's consumer, FMCG? Would you look at financial services? Because there's a lot of nervousness about the second wave of NPAs. Look at Bajaj Finance. Look at the questions around HDFC Bank today.
Well, there are two aspects to it. One is, from our perspective, we don't see the need to completely rejig the portfolio. In any case, our investment philosophy was identifying businesses with clean management, companies which make products and services which are essential to the common man, and companies which have a pretty strong competitive positions in their respective industries. To that extent, events like these actually make these companies stronger, perhaps put them in a position to be the first to recover and perhaps the sharpest to recover. And as these sort of events put question marks on the weaker companies in any industry, on the other side of the recovery, the stronger ones come out much stronger with a larger market share. So from our perspective, we don't see any need to change the portfolio. In fact, our portfolio companies have become a lot more cheaper, and we will be more than piling into these stocks. Where there is a concern, of course, where short-term effects can have a much longer-term impact on businesses is in the financial sector, of course, because of the leverage nature of these businesses. any sort of temporary problems in their borrower base could increase NPAs, and for those lenders with very weak, tier 1 capital and a weak liability franchise, this could look like a difficult period. It's not just a temporary period. You need the muscle power in terms of both capital and a strong liability base to see through this period. Some of them may not, which is where there could be a situation where temporary issues can cause structural damage. We are looking at our financials portfolio, and what we see is a pretty strong balance sheet and a very strong deposit base. There's no doubt, I think all three of them will see some impact in terms of NPAs, but I don't think it is to the extent that warrants us to relook at our holdings. We're more than comfortable with the ones that we own and will continue to own them.
Pramod, do you have a view on what shape this, if and when we get to the peak of this crisis and then maybe things start to improve, the recovery will be V-shaped, or do you think it will be a long, hollow U? I mean, what's your sense?
Well, it depends on how long this persists, based on what we've seen from the East Asian experience, where what we're hearing from on the ground, whether it's in China, Taiwan, some parts of Korea as well, things are creeping back to normalcy. I wouldn't say they've bounced back. They're creeping back to normalcy. So our sense is, if it's anywhere similar to that, if not 2 to 3 months, maybe a 3 to 6 month period where we should look back to the rest of the world coming back to normalcy. So the economic recovery perhaps will be slightly more dragged on, but the markets could run ahead of the economy, as it's always the case. And hence, perhaps with the market, and you might see a little bit of a V-shaped recovery. The economy also, remember, this is not that much of a structural supply shock or a demand shock here. There is a temporary demand shock, of course, because economic activities come to a halt. But there will be a lot of sectors where there will be pent-up demand, which will force a fairly quick recovery in the economic front as well. Where, again, I reiterate, is the challenge is through the financial system. If some of the sectors, particularly in the areas of leisure, hospitality, are leveraged to the extent that even a couple of months of weak economic activity can dent the businesses structurally, and those result in asset quality issues for their lenders, who then happen to be with weak balance sheets and weak liability bases, there could be some drag-on effect from the sort of financial paralysis of sorts, which could cause other sectors of the economy which are dependent on liquidity and leverage to take time to recover. But large parts of the economy, I would think, would recover fairly quickly. The market would recover ahead of the economy.
Okay, Pramod, thanks very much for joining us and running us through what you make of the situation. We've got a CNBC TV18 exclusive lined up next. We have